the same estimate as we did with dividends. In practice, the various approaches often differ substantially. It's those simplifying assumptions that work again. Because discounting can be difficult and tedious, lots of analysts prefer to use a relative valuation technique, the second approach that I mentioned earlier, instead. The idea is to look at the relationship between the stock price and various determinants of value for similar firms. We've already mentioned the price-to-earnings ratio. We learned that to calculate the ratio, you divide the company's stock price by that company's earnings per share. Analysts in the media also call the PE ratio the earnings multiple. Home Depot's PE was 25 in early July 2013, so people were saying that Home Depot's earnings multiple is 25. That means the same thing as Home Depot is trading at 25 times earnings. Like all of the other tools in corporate analysis, the PE ratio has its share of problems. One is the nature of accounting earnings. Generally accepted accounting principles, or GAAP, allows lots of flexibility. Hey, if you're trying to get a good picture of a huge, complex organization down on paper, then you need some flexibility. But that does make interpretation of accounting numbers and ratios like the PE tougher. For example, did the company incur a big one-time expense last period? That would have lowered earnings and raised the PE ratio. But that will be temporary if it really was a one-time charge. How do analysts use PE ratios? In December 2013, McDonald's PE ratio was 17.7. Wendy's was 247. We could conclude at least three things. We could say that McDonald's was underpriced relative to Wendy's. Or we could say that Wendy's was overpriced relative to McDonald's. Finally, we could say that Wendy's sold at a relative premium to McDonald's because its future earnings were likely to grow lots faster than McDonald's. The first two say that you trust the PE ratios and the assumptions underpinning them more than you trust the market. If so, then you should sell Wendy's and buy McDonald's. The third one says that you trust the market more than the PE ratios and that you need to study these stocks more. I know which way I'm betting. You have to be careful with PEs. They're helpful, but they can't be the only tool in your toolbox. Although PEs get taken too seriously sometimes, there's some evidence that they do predict stock returns. No, it's not perfect, but over a long period of time, buying low PE stocks tends to be a good strategy. Suppose that we look at the historical relationship between the stock market's overall PE ratio and the market's return over the next 10 years. Let's pick a long period from 1901 through 1998. What you'll find is an imperfect but fairly convincing relationship between PEs and subsequent returns. The higher the PE, the lower the subsequent 10-year return tends to be. On average, an increase of 1 in the PE, maybe to 15 from 14, tends to produce an annual return of about 0.6 of 1 percentage point less. Over 10 years, that's over 6%. Although individual stock PE ratios are highly variable, PEs over 25 for the entire market are uncommon. In fact, there are only about 3 or 4 during this sample of almost 100 years. None of those were followed by particularly good annual returns, and the average return was only about 1% per year. What's going on here? Have we found a way to earn abnormal returns? Maybe. The evidence does suggest that we do better in the long run if we buy low PE stocks and sell high PE stocks. That's not quite the same as finding a profit opportunity, though. For example, we've already seen in Lecture 4 that there's a relationship between risk and expected return, and that in the long run you'll tend to earn more if you take more risk. Perhaps low PE ratios